I've got another very special guest, and Sanjeev Sanyal, the Principal Economic Advisor, joins us all the way from North Block. Thank you very, very much, Sanjeev, for being with us. And I think congratulations come your government's way for at least taking a bold move to resolve this. Some people are calling it unnecessary. There are others who are critics. But by and large, people believe this move was warranted. I have a quick question to ask of you. What took the government so long to take this step? I mean, NPA was always the big elephant in the room. Was it not?
You're right that this NPA issue has been hanging on the economy and the banking system for a while. Other measures were used. It's not like other things were not being done. But now a somewhat different approach is being taken, which is a more targeted approach, taking advantage of the fact that in this particular instance, the problem is in many ways concentrated. Because, as you know, relatively few defaulters are responsible for the bulk of the problem, and they are concentrated also in a relatively few sectors. So you can take a certain customized solution to it in this round. And so certain powers have now been given to the Reserve Bank to carry out the operation. So in this particular case, we feel that, the process will get will get sped up very quickly from here on.
All right, the process gets speeded up, but the entire quantum or the gross NPAs at the end of the third quarter is what, about 6 lakh crore rupees, and 9.64 lakh crore rupees is the stressed asset in the system. What amount of that stressed asset or NPAs do you believe can be resolved given this empowerment that comes, given the fact that, insolvency and bankruptcy can be invoked, given the fact that the RBI can issue specific directions, given the fact that RBI can bring the dissenting banker on the JLF board? I'm just trying to understand, what is the thinking within the government? How much of this can be resolved and how much is beyond resolution?
See, I think there's some misunderstanding here. What is being done here is to provide the Reserve Bank of India the powers essentially to avoid 3 problems that the old GLF mechanism was facing. The first problem was a free rider problem, which was that there were always some lenders who would refuse to come on and sign on board to a certain resolution. So that was one problem. The second problem was a compliance problem, that once people had signed on to it, either the borrower or the lender didn't follow through with whatever was decided. And a third problem was the decisions were not getting done or delayed because there were evidently some fears that in some future date there may be an investigation and so on. So what effectively happens now is that the Reserve Bank of India can empower oversight committees that will now go through and make sure that all the processes are followed, that everybody complies with that, whatever decision is taken, and that decision is then done quite quickly. So effectively, this is what will now the Reserve Bank, the exact details of how this process will be carried out will be announced by the Reserve Bank of India. And frankly, the action will now shift from Delhi to Mumbai.
So while action shifts from Delhi to Mumbai, the ordinance, which will eventually, of course, be the law of the land, do you believe gives these bankers, or in some sense ring fences bankers to take decisions? I mean, one of the reasons why decisions weren't being taken is because any decision or any call on a haircut or any other thing like that is discretionary, and there is so much of institutional activism that India has seen, not under this government but under the previous government, that people are wary of taking decisions. You never know what you could be hauled up for many years after you've quit services or you've retired. So do you believe in some sense legislative ring fencing has happened for bankers, and do you expect more decisions to be taken?
See, commercial decisions are always prone to failure, and one has to recognize that. We recognize that when we created the bankruptcy code, because creating a smooth exit is very important to the kind of economy that we want. So in that same spirit, you will see whatever decisions are taken, whatever resolution happens, will be done based on commercial principles. And it has to be done quickly. So what effectively has been done is to provide the Reserve Bank the powers to make sure that these decisions are done on a timely basis and that processes are followed quickly and that ultimately a stamp of approval is provided to that process, so that this exact problem that you highlighted, which is the threat of future investigated, is no longer a threat, because the process was properly monitored and a final stamp of approval was given to it.
Sanjeev, there are supporters and there are critics of what you've done today, and the critics say that this amounts, or this really ends up giving RBI some infringing power, some amount of meddling authority into the decisions of what should exactly be a commercial decision by a bank's board. How are you going to refute that? How are you going to defend what the government has done vis-a-vis the charge that is being levied?
Look, the Reserve Bank of India is the regulator of the banking sector. It already had and will continue to have immense powers to supposedly meddle, as you describe. So, as regulator, it has certain powers. Now it has some specific powers for this current situation. I don't think it will meddle. What it will do is make sure that this process is sped up. It has powers to force speeding this up, and it will not, I doubt, and you will see they will announce a bunch of steps very shortly about how exactly they will go about it. And it then be quite clear to you, all that they are attempting to do is to make sure that this commercial decision-making process is done in a transparent, sensible way, that everybody complies with that decision, whatever it happens to be, jointly, the lenders, and that ultimately by providing some sort of a stamp to it, that this threat of future investigation is allayed. The Reserve Bank of India is not going to, for the most part, be involved in specifically looking up a certain asset, unless it's, in general will not be doing that. It's a general framework that is being created. This is not an attempt, as far as I would think, to try and get the Reserve Bank to look at specific assets and give specific directions on what the haircut should be. Everybody, both here at Finance Ministry and at the Reserve Bank, appreciate that this has to ultimately be a commercial process.
All right. Sanjeev Sanyal, while I nod my head in unison and I agree with you, the sharp critic of this policy or this reform measure is Maithili Basurmat, and she has questions for you, and I'm going to give the field entirely to her to take the gloves off. Maithili, this is all yours.
Sanjeev, you spoke about the need for having a framework, but the problem really why there hasn't been resolution is because frameworks don't work. Every case is a case by itself. So what banks need most of all is flexibility. So if you're going to have the Reserve Bank, and this is precisely why none of the CDR, SDR, S4A, whatever alphabet soup we've had in the past hasn't worked, because the Reserve Bank of India is not a practical banker. The Reserve Bank of India has excellent theoretical knowledge, but it should never be in the business of banking. In fact, the entire process of financial sector reform was precisely to move away from a situation where in the past Reserve Bank of India told you whom to lend to, how much to lend, what rate of interest, how the lending should be apportioned between the different bankers. You've been in a bank before, so you know exactly how hamstrung banks were. So the entire process of financial reform was to move away from that very ridiculous dirigatory system. And now we have back to the same thing. So what are we doing? Are we just looking at ticking the boxes, or are we serious about financial sector reform?
I think you're misunderstanding what has been done. This is not an attempt to do directed lending and go back to the old, pre-liberalization era. All that is being done is that the Reserve Bank now has the power to make sure that these joint lender forums and other forums take their decisions on a timely basis. The decisions themselves will not be directed by personally by the governors and deputy governors of the Reserve Bank of India. That is not at all the intention, and I think you need to wait for a little while, because they will be issuing in a day or a few days detailed step-by-step description of exactly what they will do. Then it will be quite clear to you that what they are attempting to do. This is not an attempt to go back to the old days of directed lending at all.
No, but Sanjeev, the JLR system also said that if a decision was taken by 75% of the lenders by value, 60% in number, the decision was binding. I repeat the word binding. And there was a time-bound framework there also. Again, the DRT had a time-bound framework. In the IBC code, the NCLT also has a time-bound framework, which we've seen has not worked in the case of innovative industries. So my point really is that what bankers need is flexibility. So if there was this confidence that they could act on the basis of commercial considerations without every single investigative agency breathing down their neck, they would do it. So what you're trying to do is basically just give bankers that protection from the Reserve Bank of India. But is that the way banking should be done? Should banking be done by oversight committees, in which case public sector banks might as well be an arm of the finance ministry, which was what they were prior to the reform process. Which is why my angst on this entire thing was what banks need is flexibility. Nobody asks Maruti Udyog, why are you doing what you are doing? Similarly, if you let banks do it and penalize only those who did something with malified intent, the idea should be innocent till proved guilty. Whereas in India with public sector banks, it is guilty till proved innocent. So that is why my angst. I'm really very distressed with this ordinance, which is why I think I'm questioning you so intensely.
No, I think no, I don't think you have understood exactly what has been done. That is totally not the intention at all. In fact, the steps that are being announced is precisely to get around the issue of this fear of future investigation. So these powers that have been given, if you read them carefully, particularly the last segment, then you will see what is really being done. The oversight committee is not going to declare that so and so takes so much haircuts and so on. They will by and large be overseeing a process, a commercial process, which, as you mentioned, there have been certain reasons why the compliance and free rider problems have been quite severe in them. Now with this tool, new ordinance, that will be fixed. As I said, I'm not in liberty to tell you exactly the next step-by-step description of how this process will work. You will have to just give a few days. The Reserve Bank will announce it very clearly, and you will see that all these, the angst that you have, the issues you raised, will be taken care of in there.
Right. Okay. Sanjeev, I have a very quick question then on the bad bank versus the private ARCs, and I think you must have heard people who were on the channel and they said there should be follow-up steps in terms of implementation. Deepak Parekh spoke to us just a short while back and also spoke about this. What kind of follow-up steps should we expect to make this a more enabling ecosystem? Yes, you know, the ordinance perhaps empowers the RBI to invoke insolvency and bankruptcy code. Banks will perhaps be more empowered to take these decisions. There will be less elbow room to be scared of the consequences. But I'm really asking you the big picture question. What other follow-up measures are to be needed?
Okay, let me clarify, because you mentioned the bad bank. It is a matter that was indeed actively considered, but it was decided that a bad bank ultimately is not a resolution mechanism but a warehouse. And that warehouse would ultimately have to again go into the issue of how to resolve things. So we thought that that would be an extra step that would slow down the process. Particularly, as I mentioned, we are taking a much more targeted approach, so we have opted not to do a bad bank. Now, as a second order solution, i.e. after this particular resolution mechanism has been used, it may be decided, you know, something may be liquidated, something, in some cases, you may, the commercial decision may be to convert some of the debt into equity, whatever it is. Now, it may also be the case that some bits need to be warehoused for whatever reason. Then certain ARCs may be also used, it may be a private one, a public one, whatever is necessary will be done in a flexible way. It is, you know, but it is not the first order solution. It will be a second order part of the process. The first order part of the process is directly dealing with the resolution and taking decisions quickly. And as I mentioned to you, these decisions will be taken by the banks themselves ultimately, jointly in most cases, and it will be done quickly.
Sanjeev Sanyal, two last questions before I let you go. I've got Moody's and CARE and also Fitch with me right here on this show, and so it's only an apt question to ask of you that a ratings agency like Fitch had said that banking sector reforms will turn the tide as far as the ratings in India are concerned. Do you believe that this NPA resolution, and if at all a big chunk gets resolved by this, will perhaps make India's stance or India's pitch a lot louder for a ratings upgrade, a ratings review?
Certainly, in most, if you take most macro indicators into account, India's sovereign rating is much too low. But there has been an argument that given India's banking and NPA problem, that maybe this is the one thing that needed to be resolved in order to qualify for an upgrade. We hope that this is the first step towards doing that. We hope to do it quite quickly. And wait for the Reserve Bank to come up with the next few steps. And I think I'm quite confident that once you see what is being done and watch how the process plays itself out, this last remaining sort of roadblock on the path to a sovereign rating upgrade will also be removed. Because on almost every other macro indicator, we really do deserve an upgrade.
It's a very, very optimistic and a very confident principal economic advisor in conversation with us right here at ET Now, Sanjeev Sanyal. We really thank you taking time out this evening and speaking to us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.